What if I told you that one of the richest men alive did not build his fortune by inventing an app, launching a crypto coin, flipping houses, or day trading from 6 monitors? He built it by reading, by waiting, by buying boring businesses, and by doing almost nothing for a very long time. This is the story of Warren Buffett, the man known as the Oracle of Omaha. But this is not just a story about a billionaire. It is a story about how wealth is really built. And by the end of this video, you will understand why Buffett's biggest investment secret was not intelligence, luck, or timing the market. It was patience. And the crazy part is, most people can copy the principle. They just cannot copy the discipline. Warren Buffett was born in Omaha, Nebraska in 1930. And from the beginning, he was obsessed with money. Not in the flashy way, not in the I want a Lamborghini way. He was obsessed with how money worked. As a kid, Buffett sold chewing gum, Coca-Cola bottles, newspapers, golf balls, and even bought pinball machines with a friend and placed them in barbershops. Most kids were thinking about toys. Buffett was thinking about cash flow. That is lesson number 1. Buffett did not wait until he was rich to start thinking like an investor. He started small. He learned how money moved. He learned how businesses made profit. And he learned that if a dollar could create more dollars, then time could turn something small into something huge. When Buffett was young, he bought his first stock. He bought shares of City Service. The stock dropped. He panicked a little. Then it came back up. And he sold for a small profit. Sounds good, right? Not really. Because after he sold, the stock kept rising. That moment taught him one of the most important lessons of his life. The money is not made by constantly buying and selling. The real money is made by buying something valuable and holding it. Most beginners do the opposite. They buy because something is moving. They sell because they get nervous. They jump from stock to stock, idea to idea, trend to trend. Buffett learned early that the stock market is designed to transfer money from the impatient to the patient. Buffett later studied under Benjamin Graham, the father of value investing. Graham taught him a simple idea. Do not buy stocks like lottery tickets. Buy them like pieces of a business. Imagine a small shop in your neighborhood. Before buying it, you would ask, how much money does it make? Does it have debt? Do customers come back? Is the owner honest? Is the price fair? But when people buy stocks, they often forget all of that. They just ask, is it going up? Buffett learned to ask a better question. What is this business actually worth? If the business was worth much more than the market price, he bought it. That was the foundation. Buy good assets for less than they are worth. Then wait. But Buffett was not perfect. One of the biggest turning points in his life started as a mistake. In the 1960s, Buffett began buying shares of Berkshire Hathaway. At the time, Berkshire was not the giant company we know today. It was a struggling textile business. Factories, fabric, declining industry, not exactly exciting. Buffett bought it because it looked cheap. Eventually, he took control of the company in 1965. But later, he admitted that buying Berkshire was one of his worst investments. Why? Because a bad business can stay bad for a long time. Cheap does not always mean good. That is a huge lesson. A low price is not enough. A weak business at a cheap price can still destroy your money. Over time, Buffett changed his strategy. Instead of only buying average businesses at bargain prices, he started buying great businesses at fair prices. And that shift changed everything. This is where Charlie Munger comes in. Charlie Munger became Buffett's longtime business partner, and he helped Buffett upgrade his thinking. Munger pushed him toward quality. Do not just buy something because it is cheap. Buy businesses with strong brands, loyal customers, pricing power, and long-term durability. That is why Buffett bought companies and stocks like Coca-Cola, American Express, See's Candies, Geico, and later Apple. These were not random trades. They were businesses with strong advantages. Buffett was not trying to guess what would happen next week. He was asking, will this company still matter 10, 20, or 30 years from now? That is a completely different game. Most people are playing the short game. Buffett played the forever game. Now here is where Buffett's wealth machine gets really interesting. One of Berkshire Hathaway's biggest advantages came from insurance. Insurance companies collect premiums today and pay claims later. That money sitting in between is called float. Buffett used that float as investment fuel. Think of it like this. Millions of people pay insurance premiums. Berkshire holds that money. As long as the insurance business is run carefully, Buffett gets access to large amounts of capital that can be invested. That is how Berkshire became more than a company. It became a compounding machine. It owned businesses. It bought stocks. It reinvested profits. And year after year, decade after decade, the machine kept growing. This is why Buffett's wealth became so massive. Not because he made one genius trade, but because he built a system where money kept working, profits kept reinvesting, and time did the heavy lifting. This is the part most people underestimate. Buffett did not become one of the richest people in the world overnight. A massive amount of his wealth came later in life. That is the power of compounding. Compounding looks boring in the beginning. You invest, nothing crazy happens. You invest again, still nothing crazy happens. But over time, the growth starts feeding on itself. Money earns money. Then that money earns more money. Then the snowball gets bigger. At first, the snowball looks tiny. But if you keep pushing it long enough, it becomes unstoppable. Buffett once compared wealth building to rolling a snowball down a very long hill. The trick is simple. Start early, keep going, and find a very long hill. Most people fail because they stop pushing too soon. So what can we actually learn from Warren Buffett? First, buy assets, not hype. Buffett is not chasing whatever is trending this week. He wants businesses with real profits, real customers, and long-term value. Second, understand what you own. If you cannot explain how a company makes money, you probably should not own it. Third, think long-term. Buffett does not buy because something might go up tomorrow. He buys because he believes the business can grow over many years. Fourth, avoid unnecessary mistakes. Buffett is famous for focusing on risk, not the risk of price moving up and down. The real risk, permanently losing money. Fifth, be patient. This sounds simple, but it is the hardest one, because patience feels like doing nothing. But in investing, doing nothing can be a superpower. Now, you might be thinking, okay, but I am not Warren Buffett. I do not have billions of dollars. I cannot buy entire companies. True, but you can copy the mindset. You can spend less than you earn. You can invest consistently. You can avoid emotional decisions. You can stop chasing quick money. You can buy simple, diversified investments. You can give your money time to grow. Buffett's story is not really about becoming a billionaire. It is about understanding that wealth is built through behavior, not excitement, not predictions, not trying to look smart, but behavior. The average person wants fast money. Buffett got rich slowly. The average person wants action. Buffett waited. The average person wants secret opportunities. Buffett bought obvious businesses and held them for decades. And that is the uncomfortable truth. Building wealth is not complicated, but it is hard because it requires you to be consistent when nothing exciting is happening. Warren Buffett's life teaches us that the boring path can be the powerful path. Read more. Spend less. Invest wisely. Avoid big mistakes. Let time work. And most importantly, stop looking for the one magical investment that will change your life overnight. Because Buffett did not build his fortune by predicting the future. He built it by owning valuable things for a very long time. That is the real secret. Not speed, not hype, not luck, but patience. And in a world addicted to quick wins, patience might be the biggest investing advantage you have. So here is the question. Are you building wealth like a trader chasing the next move, or like an owner building for the next decade? If this helped you, subscribe for more simple money lessons and comment below. What is one Buffett lesson you want to apply in your own life?